In October 2008, a 67-year-old retired teacher named Margaret sold everything: her mutual funds, her index holdings, a small position in Johnson & Johnson she had held for 11 years. She had watched her portfolio drop 38% in 8 months, and she decided she had seen enough. Her financial advisor told her to wait. She said she had already waited long enough. She moved everything to cash. 3 weeks later, the market bottomed. And then it did something nobody on television was predicting. It recovered. Slowly at first, then violently. By April 2009, the S&P 500 had already gained 40% from its lowest point. By the end of 2013, it had more than doubled from where Margaret sold. She missed all of it. Not because she was stupid, not because she panicked irrationally. She panicked because she was human, and because the world genuinely looked like it was ending. Bear Stearns was gone. Lehman was gone. The word depression was being used by people who had PhDs in economics and were not using it loosely. And here is the uncomfortable part. She made the wrong decision at exactly the right time to make it feel like the right decision. That is what a market cycle does to people. It manufactures conviction at the worst possible moment. We're going to talk about something today that sounds simple, but is almost impossible to actually do. Staying invested through a full market cycle. Not buying the dip, not dollar cost averaging, not picking the right sectors. Just staying in. From peak through crash, through recovery, and back to peak again. A complete cycle, the whole thing. Because here's what the research actually shows. Most retail investors do not do this. They start a cycle, they do not finish it. They exit somewhere in the middle, usually at the worst possible time, usually convinced they're being smart. And they re-enter somewhere later, usually after they've already missed the recovery they were waiting for. And the gap between what the market returns and what the average investor actually earns because of this behavior is staggering. Dalbar, a financial research firm, has been measuring this gap for decades. In 2022, their report showed that over a 30-year period, the S&P 500 returned an average of about 10.7% annually. The average equity fund investor over that same period earned around 6.8%. Same market, different behavior. Nearly 4% per year left on the table purely because of timing decisions. Over 30 years, that difference is not a rounding error. It's a second retirement account that never got built. So why does this keep happening? Why do intelligent people keep doing this? And what does a full market cycle actually look like when you understand its structure from the inside? Let us start at the beginning. Most people think of the market in terms of up and down. Good year, bad year. Bull market, bear market. The language is simple, and that simplicity is part of the problem because it makes cycles sound like weather, like something that just happens to you randomly. But a market cycle is not random. It has a structure, a shape, and once you can see the shape, everything changes. A full cycle has 4 distinct phases. The first is expansion. The economy's growing, corporate earnings are rising, unemployment is falling. Credit is easy and cheap. Stocks go up, often for years. Everyone looks like a genius. Your brother-in-law starts a podcast about investing. The second phase is peak. This is the top. But here's the thing about tops. You can't see them while you're standing on them. The economy still looks strong. The news is still good. Valuations are stretched, but smart people have been saying valuations are stretched for 2 years already and they were wrong, so you stop listening to them. The peak feels like a plateau. It feels like the new normal. The third phase is contraction. Something cracks. Could be inflation, could be a credit event, could be geopolitical shock, could be all 3 at once. The market starts falling. At first, it looks like a correction. 10% down, and every financial commentator says this is healthy. Buy the dip. Then it keeps going. 20%, and now it's officially a bear market. 30%, and now people are scared. 40%, and now people are selling. The fourth phase is recovery. This is the part that almost nobody is emotionally prepared for because it starts while everything still looks terrible. The economy is still contracting. Unemployment is still rising. The news is still bad. but the market starts going up anyway, because the market is not pricing the present, it's pricing the future. And futures traders are already betting on the recovery before the recession is even officially declared. By the time the recovery feels safe enough to buy back in, you've already missed 30 to 40% of it. This is the trap, not the crash, the recovery. Let's run a simple thought experiment. You invest $10,000 on January 1st, 2000, right at the beginning of a very bad decade for stocks. You picked possibly the worst entry point in a generation. The dot-com crash is coming, then September 11th, then a slow grind of mediocre years, then 2008. And yet, if you stay invested through all of it, through every terrible headline, every panic, every crash, through the full cycle and into the next one, by the end of 2021, your $10,000 has grown to somewhere around $46,000. That's with dividends reinvested. That's through two of the worst crashes in modern financial history. And here's where it gets brutal. If you miss just the 10 best days in the market over that entire period, your return collapses. Not dips, not declines, 60% of your return gone from missing 10 days in 21 years. If you miss the 20 best days, you're barely above where you started. And here's the cruel irony. The best days in the market almost always happen during or immediately after the worst periods. They cluster around crashes. The monster recovery days that pull averages up happen inside bear markets, inside recessions, inside the exact window when most investors have already sold or are too scared to buy back in. 2020 is a perfect example. The market dropped 34% in 33 days, one of the fastest crashes in history, and then it recovered the entire loss in 5 months. The 10 best single days of 2020 all happened between late March and early June. If you exited in February when the news first went bad and came back in July when things felt more stable, you didn't protect yourself. You just paid a very expensive tuition for a lesson you probably didn't want. Now here's the part that is genuinely interesting and not in a good way. The reason people cannot stay invested is not ignorance. It is not a lack of information. It is a deeply wired psychological mechanism that finance researchers call loss aversion. And it was documented by two psychologists, Daniel Kahneman and Amos Tversky, in the 1970s. Kahneman eventually won the Nobel Prize in Economics for this work, which is a long way of saying that what you feel when your portfolio drops is not a character flaw. It is evolutionary software running exactly as designed. The finding goes like this. Losses feel roughly twice as painful as equivalent gains feel good. Losing $1,000 hurts approximately twice as much as gaining $1,000 feels rewarding, which means a portfolio that swings up 10% and then down 10% does not feel neutral. It feels like a net loss, even though mathematically you are close to where you started. Now apply that to a bear market. A 40% decline is not just 40% of your money. It's 40% of your money delivered in agonizing increments, daily, weekly, every time you open an app. Each increment triggers a fresh loss aversion response. It compounds psychologically the same way interest compounds mathematically. And the people telling you to stay calm on television are watching their own portfolios fall. The financial advisor calling you to say, "Do not panic," is also not panicking on your behalf. They are managing their own fear response while trying to suppress yours, which is an almost impossible thing to do for another human being over the phone. So the sell decision, when it comes, feels like relief. Not cowardice, relief. Rational, calm, clear-headed relief. The kind of decision that finally lets you sleep. And that feeling of relief is precisely what makes it so dangerous. Here's what most financial content will not say directly. The market's long-run returns, the ones in the brochures, the ones in the historical charts that always go up and to the right, those returns assume a behavior that is almost biologically impossible to maintain without some kind of system, commitment, or structure forcing you to do it. Buy and hold sounds passive. It is one of the most psychologically demanding things you can ask a person to do with their savings.
because it requires you to watch something you worked years to build drop 30 or 40% in value while people on television argue about whether it's going to drop another 30 or 40% and then do nothing. Not nothing in the sense of watching passively, nothing in the sense of active resistance against a survival instinct. The mutual fund industry knows this. The index fund industry knows this. The entire structure of automatic contributions, of retirement accounts that are mildly annoying to withdraw from, of the behavioral nudges baked into 401k plans, all of it is designed not to optimize returns, but to create friction between your fear response and your brokerage account. Warren Buffett's most quoted investing rule is do not lose money. His actual behavioral edge, the thing that made him perhaps the greatest long-term investor in history, is not stock picking. It's an almost inhuman ability to watch assets he owns decline in value and feel nothing, or at least do nothing. He held through the 2008 crisis. He held through the dot-com crash. He held through 1987, when the market dropped 22% in a single day, and people were genuinely uncertain whether the financial system would open for business the next morning. He held. Not because he was fearless, because he understood cycles. Let us zoom out even further, because staying invested through a full cycle is not just a personal finance strategy. It's a statement about how you understand capitalism itself. Markets are not a graph. They are a system that converts economic activity into prices in real time, often inaccurately, always imperfectly, but over long enough time horizons, directionally correctly. When you exit the market in a crash, you're not stepping aside from a dangerous machine. You're betting that you can predict something that has defeated professional fund managers for decades. Active funds with teams of analysts and Bloomberg terminals and access to information most investors cannot get consistently fail to beat index returns over 10-year periods. The percentage of active funds that outperform their benchmark index over a 20-year window is somewhere between 5 and 10% depending on the study and the asset class. That's not a niche problem. That's a structural one. It means the most sophisticated market participants in the world, people whose entire career is timing the market, are losing to the person who bought an index fund and went on vacation. Not because the person on vacation is smarter, because staying invested removes the possibility of being wrong at the wrong time. You can't miss the best days if you never leave. And yes, cycles are getting stranger. The 2020 crash and recovery compressed what historically would have taken years to months. The Fed's intervention changed the shape of the cycle. Algorithmic trading, passive fund flows, zero commission apps that put a casino in every pocket, all of these are reshaping how cycles behave. The structure is the same, the mechanics are the same, the human psychology is definitely the same, but the speed is changing, and speed is exactly what exploits fear. Back to Margaret. She's not a cautionary tale. She's not a warning about stupidity or weakness. She's a completely normal human being who did what completely normal human beings do when they watch a number represent their security, their future, their decades of work fall every single day for 8 months. She made the most human decision possible at the worst financial moment. And she's not alone. She's the median investor. She's the person the Dalbar data is describing. She's every version of every rational person who looked at an irrational situation and tried to apply logic to it and came up with the wrong answer, because logic without context is just math on a bad map. The rule of staying invested through a full cycle is not really a rule about markets. It's a rule about your own nervous system. It's an acknowledgement that the market is designed, not intentionally but structurally, to shake people out at the bottom and let them back in near the top. That's what cycles do. That's what the transfer of wealth from impatient money to patient money looks like from the inside. The research on this is not ambiguous. The math is not complicated. The strategy is embarrassingly simple. None of that makes it easy. And maybe that's the real lesson here. Not that you should stay invested. Not that the data supports it, not that history rhymes and recoveries come, but that knowing all of this and still doing it are two completely different things. And that gap between knowing and doing is where most financial outcomes are actually decided. Not in the bull market, not in the spreadsheet, in the bear market, in the dark. in the moment when everything feels like it's over. That's when the cycle separates who builds wealth from who watches it from the outside. The question is not whether the next crash is coming, it's whether you'll still be in when the next recovery starts. And you won't know the answer to that until you're already inside it.